Mike Tedeschi, Wealth Management Advisor with Perspective Wealth Planning. In this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're going to take a look in at commodities as well, but what we're really going to focus in on in this video is the U.S. dollar. We've got some very interesting data points courtesy of Sentiment Trader that we are going to take a look at. So let's jump right into it here. First and foremost, chart of the S&P 500. Last Friday, we went out at a new all-time high. We have not made a new all-time high this week. If I zoom in on a 15-minute chart, you can see that the market is really kind of trading inside of that 37.80 to 38.30 range. We're looking for that breakout to the upside for a continued follow through, as we are still in a clear and clean uptrend up near those all-time highs. On the Nasdaq, same comments apply. We're looking for a move over that 13,100 zone to new all-time highs. We take a look in at the Dow Jones here. We are right there at that potential breakout spot at that 31,200 zone. And when we look in at the Russell continues to be the leader. It has made a new all-time high this week. It's been the only index to make a break over last Friday's high and continues to grind higher. It's been extremely strong ever since it made that breakout to new all-times back in November, which was a 3-year time frame without having a new all-time high. So we're still seeing that risk on appetite in the mid and small cap area of the market. Now, I want to touch base on commodities first here, and then we'll take a look at the U.S. dollar. Let's start with oil. Oil has continued to push up. I want to make this chart as clean as possible for you guys. We talked about that breakout at 43. We talked about that key breakout level right around that 50 zone, and that next area of resistance is right in there at 55, which comes back into play from last February before the big breakdown occurred. We have broken out from that 49 zone, and we've pushed almost all the way up to that 55. This is the area that we're going to pay close attention. If we get back up over 55, we have an easy run back to 60, and then 65 would be the last high that we've got from a resistance standpoint from last year. The next resistance point after that would actually come back from the high from 2018. So you can see the different levels that we continue to run into here on the upside. We're going to continue to watch each of those. I think it's very important what goes on in the oil market. Copper is continuing to act extremely well. We had that breakout at that 330 zones, continuing to grind higher up near those highs for the last few years. We're going to continue to look for that follow through as well. That certainly can give us a good look at the strength of the overall economy. Copper is one of those base metals that's used in a lot of industrial applications. Want to jump in and take a look at gold. When we last spoke, we had a really strong rally at the beginning of last week. We ran right into that 1960 zone, and that is where the failure took place. The market is still holding above that major breakout zone. Bulls really don't want to lose that 1820 zone and can't lose the 1750, or that would change the way I look at this chart. A move up over that 1960 is really important. We had a huge push last year for gold in the beginning of the year. A long sideways or slightly downward bias move would not be all that uncommon, digesting those gains. When we look at sister metal, silver still continues to be much stronger. As you can see, it's nowhere near that 22 low, but it too fell off a cliff essentially at the beginning of last week after running right into that key 27-28 zone. Interestingly enough, platinum is acting well. It's been a lagger for a number of years. It fell back right to that 1,030 zone of support that we've been talking about and bounced right back up or back over that 1,100 zone. We're looking for that to follow through that 1,140 high that was put in a week or so ago. We take a look in at palladium. Palladium has not really gone anywhere for the last 6 months. It does have a slight upward bias. 2,500 still the key in there. So we're going to continue to watch and see what happens at that level. Now, we don't look at it very often, the soft commodities, but I want to take a look in at them for you guys to take a look at. Here is soybean chart. As you can see right here, just a huge push up off of the bottom. The next real area of resistance comes back from where it failed back in 2013 and 2014, just above that 1,500 zone. Next, I want to take a look in at corn, which went limit up this week. So if we look in at that corn push here off of Monday. I'm going to zoom in here on a 15-minute chart so you guys can see. This is limit up right here, guys. It goes all the way up to the highest price that it can trade for the day, and then price can't trade any higher. So that's why you see those that flat line, and then we continue to push up the next day. Almost went limit up for the second day in a row, and then subsequently has fallen back down. If you're paying attention to that market, you kind of want to see that 517 zone hold. This thing has been on an absolute tear as of late, so we're going to continue to watch what's going on there. And last, I will take a look in at wheat for you guys. It's also strong, but not the same level as corn and soybean chart. But you can see a long, rounded potential base here in wheat. I'm looking for a move over that 740 zone. But this is a very similar chart to what we saw in gold, beginning of last year, where you had a 6-7 year kind of cup potential, right? So if we come back here and look at gold, you can see that 6-7 year cup, and then that push as it made the breakout there last year. So we're starting to see a lot of these commodities really start to look very interesting, and even things in the soft commodity space, not just in the metals as well. So we're going to continue to stay on top of those for you guys, and keep you apprised of what's going on there. Now, when we start talking about commodities, we want to look at what they're priced in, and that is the U.S. dollar, right? Now, here's that monthly chart of the dollar. We've talked about this a lot last year as we continued to push down, that there was going to be a zone of support coming in at that 89 to 88 level, which is where we saw back at the end of 2017 into the beginning of 2018. That's also the key level from 2010, 2008, and then it's also kind of a key zone back in 2005 and 2006. This is a very, very, very important zone. Now, when we zoom in on a daily basis, what we are going to see here is we're going to see a bounce pretty sharply off of that line that we've had drawn on the chart for a while, right? But there's still no new high put in. We're still in a downtrend. We have lower highs. We have lower lows. It's just this is starting to make that sign of a reversal. Now, when we start seeing that, what we really want to look at is we want to look at some historical data points and see whether a turning point around here makes sense from the historical data. So let's jump right into that. First, we want to take a look at, this is a long streak of staying underneath that 20-day moving average. 46 days, finally broke that the other day. It's a very, very long streak. It's the longest since 2011. How does the dollar market bode after seeing that? The dollar market actually doesn't bode that well in the mid and long term after seeing this. So when we look at this data set, this is the U.S. dollar after the first cross above the 20-day moving average in 2 months with a recent 52-week low looking back all the way to 1975 to 2020. All right, 6 months out, the dollar is only positive 30% of the time. All right, and 1 week, 2 week, 1 month, 2 months, they're right about that coin flip level, and then it does weaken over the mid and the long term. You can see a lot of times this happens in the midst of down trends that continue. A couple of times it has marked a bottom, but you can see, especially in the 2000s, we had a number of rollovers after what looked like those potential kind of bottoms. So that's kind of why these numbers look the way that they look. Now, I want to take a look at the dollar in another light as well here. I want to look at what the hedgers are doing here from a position standpoint. There is a large amount of short positions in the U.S. dollar at this moment. And you can take a look at this chart. I mean, we're right down there with a high percent. So we're looking at actually over 30% of the open interest being short the U.S. dollar. Now, some people will say, well, wow, there's all these shorts. That means we got to get a short squeeze subsequently. That's not what the data shows. Let's actually take a look at what that is. As you can see, it lines up pretty closely to the other data set that we looked at. The percentage of time that it's positive is about a coin flip in the beginning, and then it starts to weaken. And we look 6 months out later, the dollar is only positive about 30% of the time. You may have a little bit of a bounce in the short term, which is kind of what we see in the beginning of this data set, but it still looks like overall, if you look 6 months out, that the hedgers really historically have been kind of on point. So this is what I really want to pay attention to. We have a couple of different data sets that have a lot of data points, and they go back to the 1970s and 1980s. And they're telling us the same kind of story. So the idea that the bottom is in here in the US dollar probably doesn't hold a lot of weight from looking at all of this data. Now, the last thing I want to look at with this is what does this do to other asset classes when we see this type of pullback? So when we look at the same thing and we look at a 3-day gain when 1% or greater, when speculators are short 30% or more of the open interest, let's take a look at some of the things that happen. The Treasury futures end up down historically over the beginning portion, and then they tend to rise, a couple of months out. Gold tends to be a little bit weak in the beginning and then strengthens. The S&P 500 in and of itself acts strongly. Emerging markets do extremely well with this. Look at this out 3 months later. Median return of 10% with a 95% win rate off of that. Defensive stocks tend to do historically very well underneath this type of environment. Cyclical stocks, small caps, they all have a positive skew if you noticed at this, right? They're all kind of above that 50%, and a lot of them are 60, 70, 75%. Right? So what this is saying is what I have been saying for quite some time. When the U.S. dollar is weak, things that are priced in the U.S. dollars tend to be strong. So if we are going to see that historical kind of roll over in the dollar off of these data sets that we've taken a look at, that should continue to bode well for things priced in the U.S. dollar, the commodities, and the emerging markets. The last thing I want to touch on here today, folks, is the emerging markets. We had that breakout right there at that 1250 level that we talked about for a while. It has continued to soar here in the beginning of the year. A lot of individual country ETFs have done extremely well. They are outpacing the major U.S. indexes at this point, and that is something you're going to want to continue to pay attention to as an important theme for this year. I hope you guys have yourself a fantastic one. As always, if you guys have any questions, you can reach out to me at mtedeschi at Perspective of Planning or give me a call at 814-580-9881. Have yourself a fantastic week. I will see you guys next week. Take care.